All right, what I want to do today, we finished up market risk last time. I want to show you this video. This is Burton Maciel. I always get his name mixed up, but Maciel. He wrote Random Walk Down Wall Street. Um, it's interesting. One of my favorite professors, Dr. Andrew Lowe at MIT. I recommend you watch his class. He's come to UTSA. I knew him a few years ago. He wouldn't remember me today, but we were interacting back then because we invested in his hedge fund. And my department says the only reason we're buying his hedge fund is so you get to talk to Dr. Lowe. And I says that's absolutely true, and it was true. But it was also a really good hedge fund. Smart guy. You should read Dr. Lowe's books. But Dr. Lowe, in his adaptive market hypothesis, actually proves Machiel wrong. Markets are not a random walk. They actually do have patterns that are predictable, and so his random walk is got some errors in it, and it's really interesting. You read Dr. Lowe's book when he presented his analysis that markets are not a random walk. The guy who came up after him, some old PhD, said, "Yeah, there's obviously some errors in your math, but you can correct that and get back to us." And he says that in front of this entire crowd, and then he went home, checked the numbers, and he had to call Dr. Lowe and say, "Yeah, you're right." It's not a random walk. So anyway, this is the random walk. You're going to notice he disagrees with me, which is fine. I want to tell you he's not here to defend himself, so I win the argument, but I'm going to let you hear his argument, and then I'll tell you why I think he's wrong. So let's listen to this.
Saying, boy, diversification doesn't work anymore.
Have y'all heard that? All right.
We learned that in 2008 and early 2009, there were few places to hide. Everything went down together. Emerging markets went down. The U.S. market went down. Diversification doesn't work anymore. That's I can't tell you how often I read that. Well, first of all, if you were in bonds.
All right, important words right there. What did he just say? Bonds. Does he need to clarify that at all? We talked about that. What does he need to clarify? What kind of bonds? What do you think he's talking about?
Corporate.
Well, I'm talking about corporates. That's what most people buy. What do you think he's using to make his case that there's diversification? Treasuries, yeah. So when he says bonds, if you're in the crowd, you should say, wait, what kind of bonds are you talking about? Treasuries or corporates? A lot of times it doesn't matter that much. In a recession, corporates won't do as well, but it's not like, in 2008, it was treasuries were up 15, 20%, corporate bonds are down 15 to 20%. It made a huge difference. Most years, it's not that big of a difference. Treasuries might be up 9 or 10, and corporates are only up 7 because spreads widen. But here he's talking about 2008, 2009. It's extremely important. He doesn't just throw out the word bonds. And that's what people do when they're trying to make a case, is they'll pick the data that supports their case. But you can't do that in finance. You got to be much more detailed. Some of y'all are like, why are you so picky on the essays? You got to be detailed. It's the detail that is risk management. And he's being, I think, really sloppy here.
If you had some bonds in your portfolio, diversification did work. What we know about diversification, you get the most benefit when you buy an asset class that tends to be uncorrelated or very.
Another important words right there. What's a key word right there? Maybe the second word.
Uncorrelated.
Well, even before that, tends to be. When someone says tends to be, here's how risk management works really well, because these things tend to be uncorrelated. What's the first question you ask? Yeah, how often and when do they not uncorrelated? They tend to be uncorrelated, but is there a specific time when they are correlated that I would maybe want to know about? When are bonds and stocks correlated, even treasuries? 2022, what happened in 2022? Inflation. Everything he's saying here works really well if you're using treasuries, unless you have an inflationary period and you have to kick it out. But word tends, for you as a finance major, you should say, well, wait a minute, when is that not the case? You're telling me the general rule, but risk management is about the extremes. Tell me when that's not the case. That's actually more important. So the word tends, he's actually making my case. Correlations are not constant, they're not predictable. They may, on average, 70% of the time, maybe. But what's going on that 30% of the time? Because that's probably when my customer is going to be the most upset. It's like, well, on average, you're doing okay. Well, okay, but I just lost 40% of our money. Yeah, but that only happens like once every decade. It's like, yeah, I've lived 70 decades. You're going to tell me it's happened 7 times in my life. That sounds like a pretty high frequency.
Lowly correlated with, say your main asset is US stocks. Bonds actually have become a better diversifier over time in that the
Okay, why they become a better diversifier over time? This is 2008. When were stocks and bonds not uncorrelated? In the 70s and in the 80s. Why was that? We talked about that. Why were stocks and bonds highly correlated in the 70s, 80s? In the 70s, we had what? Inflation. What do we have in the 80s? Inflation coming down. What did stocks and bonds do in the 70s? They went down. What did they do in the 80s? They went up. He's saying, oh, but that's not true anymore. Now stocks and bonds are not correlated. Why? Because inflation is not an issue. Should he say that? Would that be an important thing to say, do you think? That sounds pretty critical to me. He's making it sound like, oh, the world's changed. We don't have to worry about them being correlated anymore. What is he really saying? We don't have to ever worry about inflation ever again. Is that something you want to tell your clients when you have a $30 trillion government debt out there? And, so you see how picky I am on your essays. See how picky I am. Don't you wish I were in his audience? Don't you wish you could see the two of us debate? He'd probably destroy me, but he's not here, so I win. Uh, I could better take him on than I could Dr. Lowe, though I would not debate Robert Arnott or Dr. Lowe in this room because I just let you listen to them. But him, I think I could take on.
correlations have actually fallen. So there were places to hide. In fact, what happened with bonds was the Federal Reserve was reducing interest rates to essentially zero, and bond prices were going.
Treasury bond prices went up. What did corporate bond prices do? Fell dramatically.
Yeah, so bonds were a place to hide. Now, it's true that all world stock markets became very highly correlated. Globalization has tended to increase the correlations among markets, but even though the correlations have gone up, it's still paid to be diversified internationally.
All right, so here I strongly disagree with him. And this is something you really need to think about. What is risk? We talk about it as standard deviation. If I tell you your market's going to be extremely volatile over the next 3 years, and the S&P will be up 40%, those two things are absolutely true. How risky would that be? I can tell you with 100% certainty that the S&P will be up 40% over the next 3 years, and market's going to be really volatile. Are you worried about risk? Well, if I know for sure the market's going to be up 40%, what does volatility mean? Why do we worry about volatility? Is it the volatility that bothers you? I can tell you in 2008 and in 2020, it wasn't volatility, it wasn't what was bothering us. We were worried that everything had changed and the world was coming to an end. That's what we're really worried about, right? We're not like, oh, my stocks can go up and down. No, the thing is, it's something different this time. In 2008, that weekend where Merrill Lynch and was looking like it was going to go under, and it was like, we may not survive. This might be the end of capitalism. This could be it. In COVID, we're like, what does this mean when you shut down 80% of the world? We're all working from home overnight. Those are times we're not saying, wow, we're really worried about volatility. No, we're worried about things being radically different outside of our scope of reference. And so here he's going to make the point, ignore that, look over the longer term. But what volatility is doing, it's that daily volatility, it's those losses. What it's doing is making us nervous, something radical has changed. And him saying, ignore that, just look over the long term. Well, I had a boss, my first boss in finance, his famous quote was, in the long term, we're all dead. So yeah, if you look out over the next 3 billion years, everything will be fine. It's like, yeah, no, I'm 63. I don't have the next billion years. I have 30 years. If something radical change, if I'm sitting there looking next 30 years and the US behaves like the Japanese stock market and falls 90%, and doesn't come back for 3 decades, I'm done for, right? That's going to destroy. I'm going to have to go back to work. I'm go back. Y'all see me at Walmart. I'll be the greeter. That's about what I can do, you know. So I disagree with him and to say, oh, you know, I just, and some people say this, just ignore the daily gyrations, the weekly gyrations. They freak us out, not because we don't like up and down. It's that we're worried that that gyration down is something really dramatic has happened that changes everything.
Because here you have a graph of the emerging markets in the decade from 2000 to 2010. And, you know, it's something that people often call the lost decade because it was not a good time. These are worldwide stocks. It was not a good time to be in the stock market. You ended up about the same place that you began, but emerging markets gave you a 10% annual rate of return.
So essentially he's saying, hey, there was an asset class out there that did well. If you had that in your portfolio, it would have done well. He's talking about emerging markets. And look at his, I don't know if he's going to show his slides in here, but his allocation emerging markets is massive. I don't have the numbers. I should have brought them. But if you had done what he's saying to do here, you would be incredibly disappointed today because emerging markets have done horribly versus the US market. But he picked a time when emerging did well. That's kind of what I was talking about with the pension plan, right? Stock markets did great in the 80s and 90s. So our strategy is really, really good. He's handpicking emerging that just happened to have a 10% return when the US was flat or down. But since that time, it's done horribly. And he's recommending, I think, like a 40% allocation. I tell you what, you would have been really disappointing. Maybe it would have brought your volatility down some. I don't know. I could check those numbers. But in that case, you'd be upset that you could have made a lot more money.
So the ups and downs are the same. You know, it's the fact that, you know, they look like they're very highly correlated and they are highly correlated. That still didn't mean that you didn't want to be diversified because you did much better if you were diversified and had some of the emerging markets.
Essentially, what he's saying is you're better off if you have a higher allocation to the asset class that happen to have the highest return. Anybody disagree with that? That's pretty obvious, right? If you buy the best performing stock in the market, guess what? You're going to do well. But how many of y'all are interested in the past? What are you really interested in investing? What's going to do best? Are emerging markets going to do best in the future? No, they're going to do really quite horribly. So yeah, you can make any case by looking at River Mirror and say, hey, I remember when I took the CFA exam, they had the debate on do you hedge currencies when you buy international stocks? And the paper, I thought it was a useless paper. It said you should hedge if currencies fall, but you shouldn't hedge if they don't fall. I was like, great, yeah, that's wonderful. How do I know if currencies? But that was their argument. To say, hey, if you hedge, you'll do much better when currencies are weak, and if you don't, it's like I kind of already knew that. Why'd you have me read 50 pages to say if you know the future with perfection, you'll do really well? Well, yeah, but I'm reading because I don't know the future with perfection. His argument only works well if the class he's about to put you 40% in continues to outperform the US. What do we talk about with reversion in the mean? Emerging outperformed the last several years. What is it likely to do going forward? It's actually more likely to underperform than outperform.
And again, let's sort of put these things together. The advantages of diversification, rebalancing, and dollar cost averaging. You have at the bottom.
So he talked on rebalancing. If you want to watch this, his rebalancing is fine. We have that debate. When do you rebalance? So the rebalancing is an interesting thing. Is let's say you buy all the sectors in the S&P and you want them to be somewhat equal weight or whatever, and tech stocks take off. So now you're over allocated tech stocks. You rebalance that every month, every 3 months, every year. And you got two things working against you. Always remember, you've got momentum and you got reversion to the mean. Momentum means the thing that's done well is going to keep doing well. Reversion means says eventually the thing that's done well is going to start underperforming because it went too far. Rebalancing is trying to balance those two things. Let the momentum work for you, but don't let it go so far. Rebalance so you come back down. Most studies have said do that every 3 months. This last few years, you would have been happy if you hadn't done every 3 months because tech stocks really ran there for quite a while. But that is the challenge. You're trying to balance those two things. Momentum does exist, but it's followed by reversion to the mean, and getting that timing just right is tough. And so you have all these studies about rebalancing. He talked about dollar cost average. I'm a huge believer in that. I'm doing that right now. I'm going to push my stock allocation. The S&P hit certain levels, and I'm real strict. The woman I helped at USAA with her 401k, we did that to make sure she was buying stocks on the major dips, and she actually did extremely well coming out of that. And it was funny. Market was down. She was losing money, and she was calling me all excited. I get to buy stocks today. The market's down 10%. I said, yeah, you've just lost 10%, but that's fine. You get to buy more stocks. But dollar cost average gives you that kind of discipline. And I set it up in advance. And man, when the S&P hits that level, I'm buying. I did it back during COVID. Didn't quite get as low as I was hoping to, but I was definitely buying and buying at really good spots. So dollar cost average, I believe with. I just disagree with him on the diversification. I mean,
The slide, the lost decade, you were in the S&P 500, you didn't make a penny, you in fact lost some money. And in the top part of the graph, it says you're diversified, you have bonds, you have some international stocks, including emerging market stocks, and you do a little bit of dollar cost averaging. And in the first case, your $100,000 declines to $80,000. And in the second case, your $100,000 goes up to $250,000. So it basically just gives you some numbers to go away with what I've called the timeless lessons, that by diversifying, dollar cost averaging, and rebalancing, you get a much better investment performance. The next slide, and I'll try to tell you.
Sorry, it doesn't have the slides. But his argument is very, very time dependent. I don't like arguments that are very time dependent. He threw out the correlation argument saying inflation will never happen again, essentially. He said diversification works. Yeah, everything's more correlated, but if you go out on a long enough time and you just happen to put money in the highest performing asset class that helps you, that's kind of obvious to me. So I don't agree with. I don't even know if he's still alive. I shouldn't be insulting him, because if he looked like that in 2008, there's a chance he didn't survive the 2025. Looks like he's still alive, right? So I can insult him. Obama's still alive. Ellis, I think, passed away just shortly ago. Schiller's still alive. So yeah, he's still out there, 93, impressive. I don't know if he's still doing presentations. So I'm not saying agree with me, agree with him, either way, but watch these things, but listen to those words like tend to, the correlation has changed. Well, but then why was it like that before? That's where you add value in finance and in risk management, is you listen to those subtle words. This has never done that before. Oh, well, then what happens if it does happen? What's going to happen? What would cause that to happen? Oil prices have never hit this. Okay, what if they do? What if oil prices go to 20 bucks? Oh, they wouldn't do that. Well, just pretend. Venezuela gets worked out, Iran gets worked out, Iraq starts producing again, Russia kind of works things out, Putin finally dies, whatever. Suddenly we have this glut of oil. Wow, what would happen? Oil prices go to 20 bucks. Could that happen? Yeah, that could absolutely. We'll talk about a case study that involves oil prices doing that quite rapidly, not from 80 bucks or 100 bucks, but it can happen. So that's what risk management is about, is thinking about those things no one else is thinking about things that used to be this that aren't anymore, but could they happen again? So I'm not saying he's wrong. I'm just asking you to be skeptical and question. Right. Any comments, questions on that? I'm not saying don't read his book, but I'd actually think you're better off reading Andrew Lowe's book. It's called Adaptive Market Hypothesis. It's a pretty good book, except for his last chapter. He threw it in there because he's working on a project and he just wanted to get that published. And really doesn't have anything to do with the rest of the book, so that one's a little weird. He's a really good guy, very good professor. Watch his MIT class because it's essentially your 3013. I think you might be surprised to see that graduate students at MIT are his class is no more advanced than my 3013 was. It's practically the exact same class. You would think MIT, you got all these, brilliant people, but it's a pretty basic class. You would have no trouble handling it. So MIT is not anything special. One thing I love about MIT that I wish we would do here is they were required to have group conversations. You're required to get together and talk about the class um, every week. And I wish we do that. I've been talking to Dr. Aguilar about that. I sent them MIT's approach. Um, you need to have more conversations, talking about things out loud with our dashboard team on Mondays and trying to get the students there. We talked this last Monday or yesterday. If you go into interview, how would you express what the markets have done this last week? And what we discovered really interesting is that every Monday of this month, the market has been up, and 10 out of the 12 Tuesdays through Fridays, the market has been down. And why is that? It's because Trump has been very specifically targeting his messages on the weekends. Is that unusual? Yeah, it's pretty unusual. Historically, Mondays have actually done worse than Tuesday through Fridays. Why is Trump doing that? I don't know. Maybe he has more time to text whatever he's doing. Or maybe he's just getting overloaded during the week, and on the weekend I gotta fix this, and he goes out with these messages. He is specifically moving markets. That's pretty unusual for a president to do things like that. So he's kind of unusual. And it's happened. Was that going to happen going forward? Today we had another down Tuesday. Yesterday we had another up Monday. Tomorrow looks like it's going to be an up day, but who knows? Um, those are kind of interesting things to bring up in an interview. And we bring up those things. What could you have brought out this last week? What's going on with the Fed? The probability of the Fed cutting rates? What's their dot plot? Those are the kind of things. I had a student that went to the dashboard yesterday. He got caught into the conversation at an interview, and he was telling them stuff like, "Did you know last week gold prices fell more than they've fallen in 43 years in a week?" That's kind of good stuff. So those kind of conversations, just talking about it, get used to it. And so I'd love for students to watch Mikhail's presentation and start debating. Hey, we talked in risk management about this. We talked in our eco class about this. Does he know what he's talking about? Start questioning and start sounding like a finance professional. All right, let's talk about credit risk. First thing I'd say on credit risk is out there on Canvas, I haven't looked for a more up-to-date. They're really hard to find these studies because they tend to be behind a firewall now. But I got the 2022, both Standard & Poor's and Moody's published these. If you're interviewing with a bank on the credit side, I would read this report. I know it says it's 116 pages. Most of that is graphs and tables, so it's really not that much reading. This is their default and transition study. The default is what we're talking about here with credit risk. What percentage of bonds actually went in default, and looking at it by rating category. How many AAAs went in default? How many double Bs went in default? They compare that over time. And then the other thing is transition study. What a transition study means is how many bonds that were rated AA today defaulted over the next 10 years? Or how many bonds rated AA 10 years ago, how many of those defaulted? How many bonds rated double B 10 years ago? How many of them defaulted over the next 10 years? That's the transition. Obviously, you wouldn't think many AAAs would default, but about 1% of them do over 10 years. About 50% of double Bs and below default over 10 years. And they show that to show what's going on. They also, 2022, anything unusual happened in 2022? So you got the Fed raising rates, you got inflation 2020 as well. 2020, you saw energy companies, ironically enough, and consumer discretionary firms, especially, consumer discretionary related to travel. You see someone like United Airlines and their revenue drops 80% in a year. Do you think how many people at United in December 2019 was running a scenario where their revenue fell 80%? You think they were doing that? So you saw some unusual things in 2020 because of COVID, and then in 2022 as inflation took off and energy prices took off. So you're looking for that, which industry, which sector is under most pressure. So in 2020, it was energy because oil prices were so low and consumer discretionary. And then in 2022, it was, you know, people worried about inflation, prices rising. But anytime the Fed raises rates, you tend to see certain industries under major stress. So that's what this study does. They write about that. Financial services default rose to 6 in 2022. Financial services, obviously, very sensitive to interest rates. We saw, Silicon Valley and those type of things happening, which was, related to balance sheet immunization, right? Firms betting on rates falling, and then they shot up. Speculative grade uh, doubled to 1.16%. Two financial services issues rated double B defaulted during the year. Persistent inflation, tighter funding conditions, and lower economic growth impacted credit performance of rated financial institutions. So you can see here, real focus on, they say financial institutions, they really mean banks. Um, as I said, life insurance companies are really good at this. So when you see interest rates move, life insurance companies, it's much harder for them, but they've got actuaries, so they got the right math people in there. They talk about the upgrade to downgrade ratio. That's something you can pull from Bloomberg. It's kind of interesting. Are more firms being upgraded than downgraded? What is the ratio? You can look at that over time. I mentioned, that gentleman who talked about credit spreads. This is something else you could add into your analysis, the upgrade, downgrade. And here they show you, just graphs and charts that are interesting. This is all the kind of stuff, just reading through this. If you go into a bank interview on the credit side, they'd be impressed if you knew this kind of stuff, highlight these kind of terms, and then talk about them so that it becomes natural. You don't want to go on an interview and start talking and say, oh, wait, what I meant was, you need to have it down so you don't get confused and twisted up in your conversation. So really, really good stuff. And some interesting charts. You have to kind of stare at some of them sometimes to see what they're saying. Here they give you a lot of history. Total defaults, rated defaults, investment grade defaults, special grade defaults, default rates, year by year by year. Obviously, you see a year like 2008, and suddenly everything jumps dramatically. And in 2009, even though it came back in 2009, that's when everything just started toppling. Does 2008 and 2009 stand out at all? Pretty dramatically, right? Look at that percentage. So yeah, you're seeing that, and so does it matter if you're in treasuries or corporates? Yeah, it makes a big difference in that year. Um, there's 2020, you didn't see as big of a jump there, but it was definitely a concern. I think part of the reason 2020 wasn't as bad as it should have been is our government just started throwing trillions of dollars pretty ridiculously. There were some entities that just, it was a windfall. It was like, wow, I'm glad we had COVID. They came out way ahead. Their operations were normal, and they got this big government dumping. I got a $1,500 check. I'm independently wealthy. I have plenty of money, and my government sent me a check just to make sure I was okay. I didn't experience it. If anything, I was better off because I didn't go to restaurants as much. My job paid me just as much as it was paying, and then my government bailed me out. Make sure Ron's okay down there. He may not be able to survive. So yeah, all that bailing out probably kept this number artificially much lower than it would have been. So even like United, it survived because the government just dumped money into it. So without that, yeah, you would have seen a much larger jump. But a lot of interesting stuff. They do talk about other countries. In fact, if you go back to the 70s and you see some numbers, no, they don't go back to the 70s, but in the 70s, you really saw some non-US exposures like Argentina. Again, Argentina sets the record for the most defaults. So yeah, and they say what industries. You notice insurance is pretty low. Anyway, it's a good report. Could you find a more recent one? S&P default study. You're probably not going to find 2025. It's probably not out yet. I mean, you can try. Copilot's going to try to help me with it. Here they say they have it. If you click on it and the PDF is there, then yeah, it'd be worth reading. It is a very, very good report, and it's not the same. It's not like they just edit it and update it every year. They do new stuff every year. Does that look like the entire report? Here's the takeaways for 2025. Global defaults declined for the second year. Consumer service sector led the global default for the fifth straight year. As defaults declined, credit quality also improved. More issues were upgraded and downgraded. So 2025 was a good year, and the economy did pretty well. The U.S. economy especially did really well. Um, so this is exactly what you want to know. And I have several students. I've been interviewing students, and just this last 2 weeks, I interviewed 3 that are doing bank credit. This is the kind of stuff, if you interview with them, this is what you'd want to know is going on in the overall credit environment. So good report. So there it is. Can I actually save this? I don't see a button that lets me save this as a PDF. It's probably out there somewhere. Anybody see it? Doesn't say downgrade it. There's an article related to it. Yeah, I don't. So somewhere I could save this. I don't see a little button up there, but anyway. So it's out there. The 2025 is out there. So if you're getting ready for an interview, that would be a good one to read. All right. So we define credit risk either as actual defaults, a firm doesn't pay you, or you could include spread risk, which is the risk that a firm hasn't defaulted, but its credit quality has declined, so the spread's gapped out, so you have price risk. Some banks include that under market risk, some include that under credit risk. It just depends. And I've noticed with the banks you're doing, I've seen it both ways. So how do you measure credit risk? Using credit ratings. It's the most common. I just showed you S&P. S&P and Moody's got really bad press in 2008, but it wasn't for them rating corporate bonds. It was for them rating mortgage-backed security and asset-backed securities. They did a bad job there. And part of it was incentives. You think about S&P and Moody's. I don't know if y'all know how this process works, but let's say USA want to be rated by S&P and Moody's. We have to actually pay them money to be rated. That sounds like a conflict of interest, doesn't it? You say, hey, we want a rating. Here's 50,000 bucks. Please rate our debt. And they come in and they rate it. If you don't like the rating, you can say, you know what? We don't want the rating. You still have to pay for it. And they just give you an NR, not rated. Everybody knows if you went out for a rating and they give you an NR that you didn't like the rating, that doesn't mean you're below investment grade, but it might have meant you wanted a AAA and you got a single A, something like that. But NR doesn't look good. But you ask for the rating, they come in and you have to do a presentation to them and prove you know what you're talking about. They're going to ask really tough questions. We had to actually kind of hold our CEO back. He got so mad at Moody's for one of the questions they asked. And we're like, yeah, you don't want to scream at these guys. They're going to go back. So yeah, keep your cool. They ask tough questions. They're really smart people. One time in my career, sometimes you do other duties as assigned. We had a really good model of all the insurance companies. Moody's didn't have it. And Moody's called me and go, hey, Ron, you got that model? We got this new credit rating model for insurance companies. Can we send that to you, have it run it all the insurance companies? And guess what I said? Yeah, I want to see your model before anyone else gets to see it. But they didn't have the models, so sometimes my boss used to volunteer me all over the place, but I was like, yeah, I get to see stuff first. That's pretty cool, right? So I got their model, got to run against all the insurance companies, sent it back to them, and I told my boss, hey, here's what's in their model now. So they do have these models. They're smart people. They ask tough questions. They know their industry really well. Would you want to work for a rating agency? I tell you the story of my friend Lisa. She and I worked my first finance jobs. I was so thankful she was there because she showed me how the department worked. Really smart person. She went to S&P, Standard & Poor's. Her husband started a hedge fund in New York, so he moved up to New York. And she took a job at Standard & Poor's to do credit ratings for insurance companies because we knew insurance companies really well. So I go and visit her. Y'all know where the Big Bull is in New York. So S&P is right there. I think S&P kind of actually owns that whole area. So she worked right there, right next to the Bull. And I said, what was it like? So if you want to work for S&P Moody's, let me just tell you, she walks in the first day and her predecessor had just left and there's paper stacked 10 feet high. It's a messy office. They give her her insurance companies and they leave. That was her training. So rate these companies. Does that sound good to you? You feel comfortable with that? She was really smart. She figured it out. And she says, okay, I'm ready to publish my first report. So she goes to her boss and says, I'm really published my first report. He says, okay, well, publish it. It's like, well, is anyone gonna look at it or no, no, we trust you. I'd say at least I could not have done that. I need more. I need a hug at least every once in a while to say you're doing a good job. But they were like, we hired you, do your job, figure it out. You would think you'd want to at least know the process or how this works, but they didn't tell her anything. She was much more confident than I am, and she handled it really, really well. But still, she had a little bit of interpretation of just, how you do this. So it's a tough job. If you do this job, though, you're set for life because it looks really good on our resumes. So the reason these jobs come up is the turnover is really, really high. Most people don't last more than 2 or 3 years because they're not fun jobs. They're pretty stressful jobs. A lot of travel because you got to go visit all the companies. You're kind of powerful, right? Because everybody's got to treat you really, really, really nice because they want the rating. So that's the process. What are they looking at? Exactly what you're looking at when you value a stock or a bond. They're doing the exact same things. They're looking at growth. They're looking at how much debt you have. They're looking at the volatility of earnings. They're looking at management strategies. One thing at USAA they asked about was you're expanding into the enlisted market. How good of drivers are they? And USA, oh, they're great drivers. And S&P Moody says, how do you know? Oh, we just know military people drive really well because if they don't, if they have DWIs, they get kicked out of the military. And guess what we discovered? They don't drive well. Officers drive well, the enlisted don't drive well, and USA had to pull back on that because it wasn't good. They do live longer. Our life insurance company loved them. They wanted all that business, but the property and casualty side said, you know what? They're not good drivers. I don't know why enlisted are not good drivers. Any odd known enlisted people? Do they drive as well as officers? Officers drive very, very well. That's why USA was so successful. They were ensuring the officers, they're very good drivers. USA assumed that would go to the enlisted and it didn't. See the very astute question S&P and Moody's asked. They understood not just this industry, they understood USAA. Have you really underwritten this? Do you really have the data to do this? You're expanding really, really fast to all 50 states. And USA says, hey, don't worry, we know what we're doing. And we didn't know what we're doing. It actually ended up being kind of bad. So they're smart, very astute people. You have high quality, medium quality, and low quality. High quality is anything with an A. S&P is all capital letters. Moody's is a capital and too small. S&P is the normal one. Moody's the abnormal one. So the other rating agencies are all capitals. Medium qualities is your Bs. S&P is triple B. Moody's is, you might hear it called BAA, but that's that medium quality. It's only one category, but it's a lot of companies are in that medium quality. And then low quality is anything double B or lower. S&P has plus signs. Moody's has ones, twos, and threes. So S&P would be double A plus, double A, and double A minus, or double B plus, double B minus. Moody's be B double one, double BB1, BB2, BB3. All right. What happens if S&P has them at triple B and Moody's has them at double B? What is that called? Anybody have heard of that before? So that's a split rated. All right, so split rating, and the split rating is anywhere. It can be double A and single A, but the most important split rating is triple B and double B because you have investment grade and below investment grade. So that double B is really, really critical, extremely important, mainly because the investment world, the below investment grade is their own people, and the investment grade is their own people. So there are two different groups. So when General Motors got downgraded to double B a few years ago, it was huge because they dropped out of investment grade and moved in below investment grade. And suddenly these mutual funds that own General Motors had to sell it because of investment grade. And now all these high yield managers had to figure out what to do because General Motors wasn't 1% of the high yield. It was a massive percentage. And you as a high yield bond investor, you had to say, what am I going to do with General Motors? You can't just ignore it, right? Because it's massive. So that's important. That double B is really, really important. It goes double B, single B, triple C, double C, single C, and D. All right. Triple C is pretty scary. I've given you the rating agency definitions in here. These are pretty scary bonds. Triple C's, double C, and single C. The double B's are not too bad. I would be okay. Try, over 10 years, double B's, you know, they they go default, but it's not massively. But triple C's, single, double C's, about over half of them are going to go in default over the next 10 years. So that's pretty dangerous. And then D is pretty straightforward. D for default. They have missed the payment. So that's it. Kind of worked out with the alphabet there. I like S&P's definitions. Triple A, extremely strong. Double A, very strong. Single A, strong. And triple B, hopefully your parents don't use this word for you, but triple B is adequate. All right? Adequate. They got adequate capacity. They can probably get by, but if we have a recession or some major event, they could be facing some difficulties. But right now, based on where the economy is right now, what we know, they're doing okay. Then you get double B, you use a word I always have trouble pronouncing, vulnerability. You start seeing that they're probably okay, but any weakness at all, they're gonna struggle. And that kind of gets greater. When you get to triple C, there's something wrong. Doesn't mean they're not going to make it, but they better fix it because there's something seriously wrong right now. And that just gets further and further down. Um, uh-huh.
Is payout worth the risk though?
Well, you're talking about single C.
Not that.
I mean, if you had invested, I should go look it up. If you had invested in Puerto Rico, so Puerto Rico had some serious problems and then Maria hit. That's not good. And then Trump hit. So look at Puerto Rican bonds. Maria hit, they dropped. Trump goes and visits Puerto Rico and says absolutely the worst possible thing. It comes down again. If you had bought it right there, you're talking about a bond trading like 20, 30 cents on the dollar. If they come back, you just made a 500% return. That's pretty good, right? If they default, they're still going to pay you something. So if you can buy it 30 cents on the dollar, it's possible they only pay you 50 cents. Well, if you pay 30 and you get 50 cents, you've done pretty well. So at that point, you're buying a bond that's trading for 20 cents. You're not a stockholder. Stockholders are wiped out. Puerto Rico doesn't have stockholders, but if you're a bond like General Motors, you're completely wiped out as a stockholder. But as a bondholder, GM has assets. Puerto Rico has assets. They're not going to give you zero. So then it comes down to, do I pay 20 cents? What could I get? Could I get 30 cents? Could I get 25%? So a good example is Toys R Us. Toys R Us was taken over by the bond. Management had a strategy to fix the company. And the bondholder said, no, I paid 20 cents or whatever, 30 cents. The assets are worth 40 cents. We're not going to fix this company. I want my cash. I bought it for 30 so I could sell it for 40. And the bondholders essentially killed that company because they said we can. So when you get down to single C, double C, you're not really asking, is it going to survive? Because it's probably not. You're asking, if it doesn't survive, what assets does it have and what can I get? Even Enron, you would have gotten some money back. So double A, single B bonds, you usually get more than 50% of your money back. So if you can buy that bond for 40 cents on the dollar, you're probably going to make a decent return. What is that called when you buy these bonds? You may know what that's called. It's a hedge fund. Starts with a D again. Y'all heard of distressed debt? So that's a hedge fund strategy. They don't just buy the debt, they actually cover it with options and other things. So they do a pretty good job. There was a distressed debt manager, he came by USAA all the time. We were never going to invest with them, but it was so interesting what they were doing. I always wanted to talk to them. One of my favorite out there, and you should go out to their website, Oak Tree Capital. And get Mark, I forgot his last name, but Mark, what is his name? I always forget this guy's name. But anyway, Oak Creek Capital, they're distressed debt. They were buying a bunch of bonds at the end of 2008. They were like the only ones out there. They're putting hundreds of millions of dollars into the bond market in 2008. They made a fortune in 2009. It worked really well. what is their, let's see if his name's out there. There it is. Howard Marks. That's why I can't get his name. He has two first names. That just throws me off. Have y'all read Howard Marks? Go out there, stop reading textbooks, start being finance people, and start listening to Howard Marks. He is a one-liner. If you listen to him for 30 minutes, you'll be able to produce 20 t-shirts. He is a one-liner guy. He just says the stuff that's just so astute. Very smart guy. But he talks about 2008. So if you can find him talking about 2008 and the guts they had to walk in and buy these bonds when everybody else was selling, it's really quite interesting. He's a very sharp guy. He writes really good articles as well. And he usually doesn't talk that long. He usually gets that what he's got to say out really fast. All right. So measurement here is credit ratings. There are other ways to measure it. Altman Z, I'm not so sure works all that well. You can look up Altman Z. They gave you the formula. So the formula is out there. So if you're like interviewing for a job, it may not be bad to look and see what does Altman say are those key data points. So working capital to total assets, ratio of retained earnings to total assets. That's kind of like a debt ratio, you know, how much assets versus net worth you have. Earnings before EBIT to total assets, that's kind of return on assets. Market value of equity to book value of total liabilities. So what does the stock market think versus your liabilities? Sales to total assets, that's a turnover ratio. Similar ratios you use on the stock side. So that's the Altman Z. One thing you'll notice, and I've run this math, is if you correlate Altman Z to credit ratings, there's a very weak correlation. You have to convert the credit ratings into numbers because you can't do that. But what I did is I took the credit ratings and I gave it their 10-year probability of default. So what percentage of the time does a AAA bond default over 10 years? And I put that against the Altman scores, and the correlation was really weak. So what Altman Z does is a prediction of bankruptcy. So Altman Z is not going to tell you if a firm is AAA or AA or single A. It's going to kind of mess those all together. What it's going to tell you is a firm going to default? So it's really going to help you down in those double C's, triple C's, and double B's. It's going to help you on the really weak ones. So it's a warning flag to let you know whether or not a firm's in danger. But there's their formulas, and there are other formulas out there. So you can look at the other ones out there. One I do like a lot is the Bloomberg's. Those of you know that when I run screening models, I love using Bloomberg. It does have a strong correlation to credit ratings. It actually is a good substitute. And the nice thing about the Bloomberg is they give a Bloomberg probability default to all the companies, not just the ones that actually are rated. And so if you're looking at like the Russell 3000, majority of those companies don't have a credit rating, but they do have an Altman Z. And the other wonderful thing, especially if you're interviewing for a job on the credit side, is Bloomberg does disclose what's in their formula. And so you can do the same thing you do with Altman Z and look into the details. I haven't looked at it in a while, so I can't remember what I was there, but it's a pretty good formula. We actually use it in Investment Society as our only risk measure. We don't bring in debt to equity and these other ratios, mainly because the Bloomberg probability default has all that stuff in it. And we just trust him, and he does such a good job. So it gives you one number that helps define risk. So those are good substitutes. Bloomberg default is there for every company. Altman Z, they will not give you an Altman Z for financial services companies. And you kind of see it because some of those ratios don't make sense. There's no such thing as a turnover ratio for a bank or an insurance company. So there's no Altman Z for them, but there is a Bloomberg probability of default. Bloomberg will actually tell you where their ratio fits in on the credit quality. Is it investment grade or below investment grade? And they'll show you kind of investment grade 1, 2, 3. Won't exactly line up with AAA, but it does line up. It's been a while since I ran that correlation. I should do it again to see, but it was much, much stronger than Altman Z. So remember this, because if you're working for a bank and you have a public company that you're thinking about lending money to, you could use that Bloomberg default as a good backup to what your analysis is doing. So when we look at credit risk, this is what I want you to do, and this is what you have on an exam. It's an easy exam question, but with default, with credit risk, there's two numbers. There's frequency and severity, the probability that they default, and if they default, how much will you lose? What will be, your recovery rate? So your frequency is the probability of default. That's going to be highly correlated to credit ratings. And your severity is 1 minus your recovery rate. Recovery rate is they owe you $1 million. How much of that $1 million will you get? 500,000, 600,000, 400,000. I'm ignoring the time value money, which can be important, but tends to be ignored. So like if you had loaned money to Enron, maybe you got 40 cents back on the dollar, but maybe it took you 10 years to get it. So that time value money can be pretty material. Getting 40% back today versus getting 40% back over 10 years, you'd much rather get it today than over 10 years. But I'm ignoring the time value aspect of that. The bond spread is that yield over the risk-free rate to cover you for this risk, your expected loss. All right. Now we talked about OAS. Anybody will look it up? Anybody know what OAS is? So don't interview for jobs if you don't know what OAS is. It's not the Organization of American States. Wikipedia does a pretty good job on it. Wikipedia may be going out of business, right? Because Copilot AI probably does a better job. The problem is the circular thing. Where does AI get a lot of its stuff? From Wikipedia. Where's Wikipedia getting a lot of its stuff? From AI. I'm kind of wondering what happens when AI gets its stuff from AI. It's going to be kind of interesting to see. So be real careful on options. Sometimes I've seen it wrong in Wikipedia, so you have to be a little bit careful here. And OAS is one place where they tend to get it. So if you think about a mortgage-backed security gives you the right, if you're borrowing money, gives you the right to pay off that mortgage early. And when do you pay it off early? When it's in your best interest or in the bank's best interest? When it's in my best interest. Does the bank want you to pay it off early? You got a 7% coupon and you're going to pay it off and reborrow at 4%, that they want you to do that, or would you rather you keep paying at 7%? They hate you doing that. So essentially what the bank has done is they've charged you extra, probably about 25 basis points. So instead of charging you 6%, they're going to charge you 6.25% to give you the right to pay off that debt early. That extra 0.25% is essentially they're selling you an option. All right. So a mortgage-backed security, if you as an investor, not as the borrower, as an investor, you're buying a bond and you're selling an option on interest rates. That's what a mortgage-backed is. It's a pretty complicated security. If you want to hear my history with mortgage-backed securities, go watch our YouTube channel. I don't know if y'all seen that. Luke interviewed me in my first interview. I was like, I think USA is going to sue me for this one. But I exposed, I've heard of David and Goliath. This was David versus 3 Goliaths. I was taking on the 3 biggest, most powerful people at USA so stupidly because I didn't know. I was like, no, we're going to sell our mortgage-backed securities, and they're like, no, we're not. So it was pretty interesting. It's kind of nice to have the president of the investment company write a letter to the board of directors complaining about you personally when you're just a peon analyst. That doesn't look good. But I won that debate. Why? Well, because I had just taken the CFA exam. I'd been talking to life actuaries. I know about option adjusted spread. I know about embedded options. I had learned all that. The guys I was fighting learned everything about bonds in the 60s. And they had become dinosaurs. How do you not become a dinosaur? I'm worried I'm becoming a dinosaur because I've been retired for 16 years. But it was me, David, versus 3 humongous dinosaurs. But you thought I would have gotten fired. But watch the video. You can see what saved me. I was really, really lucky what saved me because of a new board member that came on. But you need to be paying attention. So, learn this stuff because it comes up. So this saved me. but it was on the CFA exam. I didn't get it in college, undergraduate. But what is OAS? What OAS says is you got this bond that's paying you 6.25, but 0.25 of that is actually an option premium. Let's take that option premium out and see what the spread is without that. All right. And that's what the OAS is, option adjusted spread. It's the spread you're getting if you didn't give the person that option. All right. So a good way to think about it is the bond has a coupon of 6.25. The option is 0.25%, and treasuries are paying 4%. So our spread is 0.0625 minus 0.04, or 225 bips. What's a bip? Basis points. What is our OAS? Our OAS is 200 basis points. Why? Because 25 basis points is an option premium. The option adjusted spread is the spread without that option in it. Now, I've seen Wikipedia and Investopedia say the option adjusted spread is the 25 bips. That is not correct. So be careful, all right? So when you borrow money from a bank for a mortgage, you're paying an extra amount. What if you tell the bank, you know what, just charge me 6%, I promise never to pay off early? They're not going to let you do that. First of all, I don't have the time to mess with just one person. Secondly, there's no way legally they can force you to do that. So you're forced to buy this option. You're not given any choice to do it. Is this option spread constant? No. When does it go? It rises when? If you took my investment class, you would know this. It rises when rates are what? Volatile or low volatile? High volatility or low volatility? When do you like having an option? When things are volatile or when things are not volatile? When they're more volatile, when rates are more volatile. And they fall when rates are less volatile. What that means is when interest rates are really, really volatile, that's probably a good time to buy mortgage-backed security, because that means the option, the spread above the OAS is going to be really wide. It might be 75 basis points. When interest rates are really, really stable, you probably don't want to buy mortgage-backed because that extra spread might only be 10 basis points. All right. You can get the actual spread, the true spread, off of Bloomberg. They'll show it to you. So you have to bring it, you just click on the mortgage button, bring up a mortgage-backed security. You'll see the OAS and you'll see the total spread. And historically, and I read this in an article and I can't confirm it, historically that extra spread over the OAS is about 25 bips. But if you're looking at Bloomberg and you see the extra spread now 60 or 70, you say, man, this might be a good time to buy that mortgage-backed security. So anyway, so that's just, when we talk about spread here, we are talking about the option adjusted spread. We're taking that out. Now with the treasury, well, there are no spreads, but with a non-callable bond, the OAS and the spread are the same because there's no optionality. You can't pay it off early, right? So this is the extra yield, but it's the option adjusted yield over the risk-free rate. All right. So just be real careful with that. That was the problem I was having. The people at UTSA, they were saying, wow, these bonds are AAA rated and we're getting this massive spread. I mean, these are the greatest bonds ever. And they're really liquid. And what they were missing was that extra spread was to pay them for the risk of these bonds prepaying. And they were completely ignoring that. And in the letter, his letter to the board, he actually said these bonds do better when interest rates become more volatile, which is exactly the opposite of what my textbook said. And my boss said, Ron, you got to write a letter to the board debating him. And I go, what, you want me there? I'm just an analyst. And why was my boss saying that? Because my boss wanted nothing to do with it. If someone's going to get fired, it was going to be me. It was going to be him. He didn't want his name on the memo. He wanted it all to be me. So I had to write a letter. How do you write a letter to the board? It's like, do they have addresses? Where do I? So I had to go over to Tim's apartment. Tim, I'm supposed to write a letter to the board. I just stuck. The guy who wrote the letter about me, he talked about how stupid I was. I never bought a bond in my life, which wasn't true. I had bought one bond in my life. He says I was all academic, and that was true. All my learning was academic. But he complained about me. I didn't mention him anywhere in my memo. I just said, here's what I know. This is why I don't recommend these bonds. They don't make sense for USAA. We had 70% of our portfolio in mortgage-backed securities. Can you believe that? And so I had them go to zero. And for some stupid reason, they listened to me, but it was actually pretty good. We did that. But it helps to know this kind of detail. So if you don't know option adjusted spread, I would learn it. You're going to see words like embedded options. That's going to be there. You're going to find things like convexity. That's extremely important. You're going to find things like effective duration. There's a lot of terms here. If you get the Fobosi book on fixed income, which I think if you take John Tui's class, I think he uses the Fobosi book, maybe. Any of y'all took his class? I've taken his class. Did he use Fobosi? No. Did he use the textbook? Oh, okay. He's probably using it himself personally. But if you get the Fobosi book, I mean, a big chunk of that book are these asset-backed securities. It's probably over a third of the book. So you can't say, well, I want to do bonds, but I'm not interested in this. This is a huge part of bonds. It's really pretty critical. Where do you get this? CFA level 2 is very, very heavy on this. That's where I got most of mine. So it's kind of sad at USAA you had this kid who took the CFA exam. That's where he learned about these, and now he's telling USA to sell, $20 billion in these bonds. But they listened to me. They did it. But fortunately, what I was reading was really pretty good. We hired a professor from UTSA to come teach us about mortgage-backed securities. I went to that class. The life insurance actuaries invited me. So I was getting some really, really good education, but still I was pretty scared to death. My friends in the investment company, my age, they all were on my side because they understood the stuff better than I did. And they're just watching to see how long I survived. They were like, yeah, he's done for. They were shocked I was stupid enough to take it on. But sometimes knowledge is quite powerful. It may not be as powerful as politics, but I won the game here. So option adjusted spread, very, very important. We talked about that on an interest rate risk. That mortgage-backed security, the extra 25 basis points, that's not a credit issue. That's an interest rate issue. So it's extremely important to understand that from that standpoint. So here we're focused just on the OAS, just the credit portion of this. So let's say your probability to default over 5 years is 5%, and your expected recovery rate is 40%. So that 5%, you're going to lose it on average over 5 years, which means that bond, you're going to lose about, that type of bond, you'll lose about 1% a year. The spread you get, that extra OAS, you get every year. All right, so you don't need 5% spread, you need 1% spread to cover you for the default. But then you have recovery. So you need about 1% a year to cover the defaults, but you can get 40% back. So you need about 60 basis points. A bond that has a 5% chance of defaulting over 5 years and a 40% recovery, if you get paid 60 basis points, you'll be exactly covering that default risk. All right. So let's look at this Moody's study that I gave you. I don't know when I put this out there. So here's the cumulative default. I'll give you something like this on the exam. Come on, Bill Gates, you can do it. You can't do it. Why is it not working? Always. Okay. So this is a transition matrix. They're showing you, well, there's two types of transitions. So this isn't actually a transition. One transition matrix is what percentage of firms that start AAA are still AAA 10 years later. So that's one transition. This is another transition. A firm that was AAA today, what percentage of them have defaulted over 10 years? So you can see it's kind of actually nice. For AAA and AA, it's essentially 1%. So how much do you need every year to cover you for that? You have 1% over 10 years, 1% divided by 10, about 10 basis points. Not much, right? Double A and triple A almost have the same one. You go down to single A, it's a little bit higher. Triple B jumps up to about threes. So I would kind of have these memorized. All the A's is about 1% default. The triple B's is about 3%. And then when you drop down to triple B's and single B's and triple C's, you're starting to see much higher numbers. Investment grade is about 1.5%, spec grade about 10%. But you see these numbers and they give you some indication on what your spread. Now, that would be the max spread you need because you do have the recovery. All right. So you think the max spread you need for a AAA bond is only 10 basis points, and yet they pay like 20, 30 basis points. They overpay you like 3 times as much as you need. That's even before recovery. AAA bonds recover about 50%. So you really, for AAA bonds, over time, you only need about 5 basis points, and yet they pay you 20 to 30 basis points. So I mentioned I had purchased one bond before that whole thing blew up at USAA. The one bond I bought was a Treasury, and I only put $5,000 in it. And the only reason I did it was to see how to buy a Treasury. And I got in all kinds of trouble at USAA. The guy I was doing analysis for is, we don't buy Treasuries at USAA. We only buy corporates. They don't pay enough. And that was his argument. You're getting paid more than enough with the spread. And I said, I was just buying this Treasury just to see how to buy one. I wasn't like making some theoretical purchase. So this is a good matrix to know. I doubt it's changed much with updated through 2025. If I could find it through 2025, I would show it to you. Maybe I'll find one before the exam. But that's what we're looking at. But this is only the default. It doesn't include recovery. So you do have to put that extra piece in there. All right, so I'll show you the exam question next class, but all it really does is it says, okay, here's my probability of default, here's my recovery rate. I need this bond to pay me at least 20 basis points. The spread is 80 basis points. I'm getting paid more than my risk for default, but what other risks are out there? All right, and we'll talk about those other risks. Here we're only talking about default risk. What other risk is there? There's spread risk. Spreads gap out in a recession, so that bond's going to lose you money even if it doesn't default. And the second one I just alluded to with the Mikael YouTube is the whole concept of correlation. When are these spreads going to gap out? During good times or during bad times? During bad times, which means what? What's the correlation of corporate bonds going to be during a recession? The correlation to stocks. What did bond correlations do? Corporate bond correlations do in 2008? They jumped up, right? So you got that correlation. So here we're just talking default. So corporate bonds more than pay you for default risk, but you do have that correlation risk where corporate bonds do badly in a recession, the worst possible time. And you have that spread risk where the spreads can gap out even if you don't have the default. So you do need some extra compensation. Most investors will tell you you're still getting overpaid for corporate risk. They do pay really good spreads. Right now, the spreads are pretty narrow. So even though it is more than the cover you for default risk, it's not as much as they paid you historically. They're pretty thin. So we'll get into that exam question. How do you mitigate it? This one's pretty tough. Risk limits is pretty important, either at the security level or at the industry level. So you might say no more than X% in any one entity. Make sure you don't have too much in consumer staples or in financials or whatever. So you have to watch that. I had to set these risk limits for USAA, and I did it by credit rating. So I said, hey, if it's AAA rated, we can have 5% in a bond. If it's triple B bond rated, maybe only 2%. Below investment grade, only X%. I took that to the CEO, and he goes, no, those are too high. And he said, go back and run your models and come back to me. And I'm like, I don't have any models. I just pull those numbers out of thin air. But I said, okay, I'll go back to my models. I came back with lower numbers. He says, no, those are still too high. Go run your models. I go, okay, Bob, I don't have any models to run. I need a number that you want me to put in here that you can sleep with at night. And so he gave me some numbers. That's what we came up with. Like, there's nothing for me. What am I going to do? So we came up with some numbers. The bond people at USA were livid. They were so mad because they were buying like 50 bonds. Now they're going to have to buy 500 bonds. It's like, great. They're mad at me. It's like, it's not my fault. They're mad at me. Now we got to go buy 500 bonds. At the time, we had a list of our highest exposures. And our number one exposure, you might want to guess what our number one exposure was? What ironic name would be our number one exposure that I've already mentioned in class? No guesses? You all heard of them, firm name Enron?
Yeah.
That was our number one exposure. They had now had to go out and sell Enron and replace it. So our exposure to Enron went from huge to almost nothing. Then they were calling me and going, he might be smarter than we thought he was. So we dodged a bullet on that, and they were like, I'm so glad he took us from 50 bonds to 500 bonds, because we really went from massive number to an almost nothing number. But those risk limits, why do you set it out? There's really no mathematical way to say how you're going to set that limit. You just have to decide what you can live with. But he did go with the idea of AAA, double A, single A has a higher limit than triple B than investment grade. You hope the covenants are good. You could use credit default swaps. I'm not a credit default swap person. I've never used them. I'm not real comfortable with them. Have y'all talked about them in some of your classes? Does John Tui talk about them in his class? Some? No? So if you read your bank's credit section, they probably have credit default swaps in their risk management for the credit side. So I've never used one. I can't give you any background on them. To me, they don't sound like swaps. They sound more like options. Just the way they're structured. They seem weird to me. But why did AIG go under? They were selling credit default swaps and then just got crushed by that. So if you were to do the credit section of your banks, and you're really glad I didn't give it to you, you discover that it just goes on forever and ever and ever, because it's a pretty difficult risk to measure and a pretty difficult risk to mitigate. And so what banks have to do, and the reason the section is so long, is they got to talk about real estate differently than corporates, differently than the retail side, differently than mortgages, commercial mortgages, residential mortgages. So what you end up with is these major sections by different types of debt. That's why I didn't give you that, because it's just too much to do. So what we'll do next class is we'll work the math problem from the exam related to credit risk, and you'll see it's a fairly straightforward question. All right, any questions on anything? All right, let's start. Tonight we want to talk about credit risk, look specifically at the exam question, but also the essay part of that exam question. I change my list every semester, but I think there's a good list. So if you look under exam reviews, exam 2, example problems, we'll start with that one. So it's a very, very simple question. So here's the cumulative default rates for financial services companies down here. U.S. financial services cumulative. I got through 2021 on this question. I'll try to get it up to date. This is what I get from S&P and Moody's. And then I give you recovery rates. And this question is asking about triple B rated, 10 years. All right, so you find triple B and you go out 10 years and you find over 10 years about 4.75% of them default. All right, but that's over 10 years. You're getting your spread. We're talking about the spread that you get every year. So how much would you need every year? So the cumulative default rate's 475, but that's over 10 years. So you need 47 basis points, 47.5 to cover you for defaults. Make sure you can switch between basis points and percents. I had an exam where someone typed 6% as 6. So they took 1 plus 600%, and they got some really wild answers. So, you should be really very easy to flip back and forth between percents and basis points. So you need 47.5 basis points, but your recovery, we said, was 30%. So you're not going to lose 47.5, you're going to lose 70% of 47.5. So you expect, on average, every year, that default risk net of recoveries is going to cost you about 33.25 basis points. But these bonds are paying 160 basis points. Wow, that's a huge compensation, right? So here's my official list. I might add to it. But why do you get much more than just the credit default risk? Well, Part of it is liquidity. These bonds do have a liquidity premium. Corporate bonds are not liquid securities. If you're buying corporate bonds on Schwab or wherever, Robinhood, you're getting crushed on the bid ask. You're paying a really high price. I know there's people who buy municipals. You really shouldn't buy municipals because the bid ask is just going to crush you. And it's really important on bonds on the bid ask because you're only making what, 4 or 5%. And the bid ask is costing you 2, 3%. You're crushing a lot of return. So liquidity is there. Bonds, corporate bonds are illiquid securities. Even for the big investors, USA would buy them in 20, 30, 40, $50 million blocks, but there's still, it's expensive to trade bonds. So there's a liquidity premium. Not true with treasuries. I buy treasuries all the time. They're very, very easy to buy. You get a good return. Then there's the spread or the price risk, and just the fact that these bonds do get repriced because people change their opinion on how risky the bond is. You might have a bond that's paying you, 100 over, and then suddenly they get worried about it and that jumps to 130. Well, the price is going to fall, even though you think the probability of default went from 4% to 6%. You say it's still got a 94% chance of paying. But the simple fact that the spread gapped out is going to hurt your price. So you have price risk or market risk. And that's just because spreads gap out. What word do we use for spreads? If spreads go up, what word do we use? Make sure in your interview. I don't know who comes up with these terms, but you should know the nomenclature. Did they increase? They get bigger? What do they do? Any guesses? Starts with a W if that helps you. They widen. And what do they do when they come in and get smaller? They narrow, yeah. So use those terms. You're going to sound much smarter in an interview and say, man, corporate spreads really have narrowed this last year, even with all this risk. Narrowed is the right word, not got smaller, came down. So spreads, for some reason, I'm hoping some UTSA students going to create the next term. We're trying to create one for these trillion-dollar companies out there. We're calling them not unicorns, but Pegasus. So we're trying to get that term when UTSA create that one. So anytime you hear someone talking about one of these AI firms going public at $1 trillion, say, oh yeah, that's going to be the first Pegasus. And then just talk like it's a normal word. Don't even say, don't tell them the definition. If they say, what? Is it Pegasus? Pegasus, the firm that goes public at $1 trillion. So, all right. So spreads narrow and they widen. When they widen, you're going to have price risk. Your price is going to fall. Even if you don't think the probability of default has gone up all that much, you're still going to see the price move around. Then you have the tail risk, where these bonds, they really underperform in extreme situation, like a 2008, where they really, really underperform. You need some compensation for that. There are times where you're really happy you have treasuries. Over the long term, you probably are almost certainly going to be better off with corporates over treasuries. But in a given year, risk is, that 1 year where everything just blows up. In 2008, remember, you had that massive. In fact, I went back in tech 2008. I was telling my friends at USA, these poor guys in the fixed income side, boy, they were shell shocked. You could see, I used to tell them, hey, if you see John in the hall, give him a hug. I mean, that poor guy, that was a horrible year for him. But I compared 2008 corporates versus treasuries to the Great Depression, and 2008 was worse. As far as the comparison, how much worse corporates did than treasuries, 2008 was worse than the Great Depression. And then the last one we talked a little bit about is correlation risk. We saw in 2022 that treasuries, corporates, and stocks all did badly, but that was the inflation side. But if you're talking about something like recession or geopolitical risk, treasuries give you great diversification. Corporates don't. In fact, there's not many places where corporates help you where treasuries are hurting you versus stocks. So there are times where treasuries are great diversifier, especially in times of stress, recession, those kind of things, where corporates are going to do badly. So you have this correlation. They don't give you the correlation benefit that treasuries give you, and therefore that's probably going to give you a little bit more spread as well. I know tail risk and correlation risk are somewhat related to each other. One's just talking the extreme. Is that enough to justify that higher? I don't think so. Most bond people will say corporates make a lot of sense. I think right now with the spread so narrow, I'm kind of worried about this risk because corporate spreads versus their history look really narrow. That doesn't mean I don't think you're not getting paid adequately. I just worry that we go back to normal and you're going to see this adjustment to the price. Right. So you need to have this list on your exam. If you do it exactly like this, you're probably pretty close to getting all values. So that's the question. Pretty simple. You see which bond am I asking about? What year? What rating? You're then going to take that probability over. That's cumulative, right? This is the transition. This isn't each year's default. It's the default cumulative over time. So the numbers will never go down. Divide that by 10 because spreads paid annually. That tells you what defaults you expect, but then you're going to get recovery. So you take that back out. And that tells you just to cover default risk, these bonds should be paying you 33 basis points. They're actually paying you 160 basis points. Is there some good justification for why it should be higher than 33? And then there's a list of 4 things. Very straightforward type of question. There's a few more of these out there on Canvas if you want to practice them. They don't all have the same list, so just be careful because I keep changing the list every time. Here's some exam questions. And here you can see the list is slightly different again. But here I use a different one. This is one really old. So I like this one, but I can't get it updated. So we'll see what I can get from S&P or Moody's. But similar question. Again, another similar question. So you have some to practice with. We'll do some before the exam. Our final exam is really bizarre because our last class is May 5th and our exam is May 7th. That's really bizarre. So we'll probably have the last class, the second to last class be the exam review. And then the last class, I'm going to finish it up with what are the risks I think you should be most worried about going forward. But so we'll have to handle that. I've never had a final exam that quick after the end of the semester. Any questions on this? This would be a good thing to bring up in an interview if you're interviewing with on the credit side. So I think corporate bonds provide really good spreads over treasuries given their default risk. And you know, this whole conversation would be a very sophisticated one to have in an interview. So yeah, you'd be comfortable with it, but it's pretty straightforward. You can say the same thing with municipals. Just really good spreads. There has been some debate with rating agencies that there was some thought that rating agencies underrated municipal bonds, and that's why their spreads didn't make sense. But the rating agencies say they've updated their models. So if you look at a municipal bond versus a corporate bond, the probability of default should be the same if they're the same rating. They argue that. I can't really test that for you. To me, municipal bond spreads do not make sense. We'll talk about taxes later. So the 10-year treasury today is what? Getting close to 450 again, right? Here's the yield on high yield. I mean, on tax exempt, intermediate tax exempt, that's more like a 5-year bond. So 5-year bonds right now are yielding about 408. All right, what's happening here? These bonds are yielding 337. So why is it lower? Well, because they're tax-free, so you have to make the tax adjustment. But if you look at municipal bond yields the last several years, they've been all over the place. There have been times where their yield was much higher than treasuries, which doesn't make any sense at all. And now their yields are much lower, but they should be lower because of tax law, but then you also have the credit risk. So you might look at municipal bond spreads over time and see where we are today. One thing that has bothered me with municipal bonds, I have a municipal bond investment with Victory Capital, and I kind of tease those guys, but there's days where my corporate bond portfolio is down, but the municipal is up, and then the exact opposite. So what is going on with municipals? Is there anything going on with municipals that's unusual right now? Are cities and states under stress financially? Is that what we're talking about? So, you know, it's interesting. If you take my investment class, we talk about how do you decide between municipals and corporates. It really does come down to taxes. But I'm also kind of curious, why are we seeing these strange gyrations? It really doesn't. If S&P and Moody's are correct, they're rating municipals correctly versus corporates, taxes should be the only adjustment. Your tax rate should be the only adjustment, but there's something else going on with them, kind of bizarre. So be careful. Don't tell your uncle, oh, just buy municipal bonds, save the taxes. You better make sure the yield is there for you. Otherwise, buy the corporate. So here you have this yield 337. Here's a taxable fund. It's yielding 460. That sounds pretty good to me. What did I say? 337? You take 337 and divide it by 1 minus your tax rate. Let's say, that's 480.6 would be 560. You make that adjustment, you can decide between the two of them. I think the 480 on the taxable looks pretty good right now because my tax rate's not that high. But anyway, that's the kind of math you got to do. But I can't explain to you why municipal bonds have been just all over the place here recently. All right. Find. All right. So we define this. Remember the definition here, it can be a little tricky. Are you talking about default? Are you talking about default and price risk? Talking about spreads. Some people define it differently. You measure it almost entirely by credit ratings, and you mitigate it with policy, how much exposure you have. Usually it's some type of limit. And then you assess if you're getting paid for the risk by looking at this formula and figuring out what your spread is versus what it should be. Pretty straightforward. I don't know in John Toohey's class if how he's covering credit risk. If you've analyzed the stock, it's very similar analysis that you do if you're analyzing a bond. You're looking at the same ratios just with a different perspective because you don't get the upside on the bond, you only get the downside. I brought this list in my class notes, but you'll have it on that very first exam answer. Can y'all think of any other reason corporates might give a better spread than they should? Sometimes I'll think of one off the top of my head and have to add it to the list and I forget I added it. So this will be, if you brought this up in an interview, they'd be impressed. That's a pretty good list. I think just over time, we've thought of more and more things. All right. So let's get into some of these other smaller risks. Some of them are quite fascinating. Some of them give me nightmares, especially currency risk from my years at USAA we'll talk about. All right, the next one we call basis risk or tracking risk. Basis risk is exactly what I showed you with the USA pension plan. It's you're hedging something, but the thing that you're hedging and what you're using to hedge it don't move together. Over time, that might move together, but suddenly they don't. I showed you with USA, it worked in our favor, right? We were hedging our liability and our liability fell and our hedge instrument went up. It's like, wow, this is great. So we tripled our net worth in 1 year because the hedge messed up. We're going to look at a case study here a little bit later, which some people call a basis risk case. Some people, I love this particular article. It says that hedging is speculation on the basis. You're assuming your hedge works really well, and then suddenly it doesn't. So you're attempting to hedge a risk, which is good, but the hedging instrument does not behave as expected. And here I say causing a loss. We saw this at USA, but actually caused a gain, but you're a little bit surprised. How do you measure this? You measure it with something called tracking error. We'll talk about tracking error when we do project 2. We'll get into project 2 probably next Tuesday once you get paper 1 behind you. So tracking error is pretty simple. It's just you take what you're hedging and the hedge, you take their returns, take the difference. The standard deviation of that difference is tracking error. You'll see it when we do project. So it's the standard deviation of the difference between the return that's being hedged and the return on the hedge itself. Value risk can be done as well. You can look historically at that tracking error and that can tell you, hey, how bad could it be? So you could do a value risk analysis. In fact, a lot of these value risk is a good way to do it. You just look back historically How do you mitigate it? You test, you double test, you run it under different scenarios, especially in a crisis. Maybe change the hedge ratio in some way, but it just comes down to testing it. Don't tell your boss you're hedged on something that could blow up. The last thing you want to do is tell your boss you're hedged, and your boss says, "Oh man, I'm glad we hedged." Well, yeah, except for we actually lost 300 million bucks. The hedge didn't quite work. They're like, "What?" That happened in Merrill Lynch. Merrill Lynch CEO kept saying, "Oh, we got that risk hedged." Yeah, so now you're insolvent. So yeah, it doesn't sound like it worked. Um, so match as close as you can. If you've got a technology fund, don't hedge it using S&P 500 futures. You have to find something that's a little more consistent. You even got to be careful using options and other things on like ETFs because the way they can behave in really strange ways. Get as much data as you can and look back historically and see what happened and make sure your historical data has an unusual period of time. So you're really testing those extremes. We'll talk later. You understand risk at the extreme. You have to go to those extremes and understand them. 2008 is a good extreme. 2020 is a good extreme. 2022 is a good extreme. You've got some pretty good data out there that shows you an extreme, but be careful if you're hedging. Don't tell your boss you're hedged and you have this kind of risk out there that could really bite you. All right, that's basis risk or tracking risk. You hear those two terms. Pretty kind of seems simple, but it's actually pretty important if you're setting up that kind of transaction. But yeah, we're going to have an entire case study where a firm tried to hedge oil prices. And what they discovered was oil prices and their hedging vehicle, which was futures, got out of whack in a way that caused them some pretty significant risk. There, the basis risk was almost entirely an accounting risk more than it was actual true market value risk. The accounting messed up and then just freaked people out. All right. The next one is model risk. Model risk is you're modeling something, your company, and your model is just not well calibrated. It's got errors in it. And the more complex the model, the worse it is. Because then you get, and I love this phrase, I heard this at a conference. We talked about Peter Bernstein earlier in the class. This was the conference he was speaking at. One of the actuaries spoke after him, and he did this phrase, so I stole it from him. He called it garbage in, gospel out. And what he meant was the model is so complicated. It's got these massive formulas. It's all fancy. It must be really good. But it's not. It's all garbage. But people take the output and say, wow, it must be good. Look how complicated it is. We have this PhD in math. We have these actuaries putting it together. It must be really, really good. So the more complicated the model, almost the worse it is for fooling you because you over rely on it. So got to be real careful. How do you measure it? It's just comes back to complexity. How complex is the model? You will be building models during your lifetime. What's the chance you have errors in Excel? Somewhere close to 100%. What's the chances your error in Excel is material or immaterial? You don't know that probability, do you? And how do you figure that out? It's pretty tough to do. But this is your life. You're going to be building models the entire rest of your life, probably even after you retire. So you've got to get good at it. The FMVA is what the Corporate Finance Institution puts on. We're really encouraging students to get the certification. They spend a lot of time on Excel modeling in a way that reduces those error possibilities. It's the complexity of the model and it's the complexity of what is being modeled. Both are pretty important. We tend to rely very heavily on historical data. The further back you go, maybe, so this is kind of the question, maybe you're going back so far, the data doesn't really mean anything because the world's changed. But sometimes going back can be really helpful because, maybe World War II will never happen again, but it's kind of interesting, how did that happen during World War II, or how did it happen in the 70s with the oil embargo and high inflation? It's a question, how far back in time do you go? Most people in finance We're hungry for data. If I can get 50 years of data, I'm going to use 50 years of data. Then what I recommend is, and we'll talk about this in a mitigation, is don't use all of the data in your model. Use different chunks of it. Use this 10-year period to set it up, and then test it against a different 10-year period. Don't over calibrate it so that it perfectly matches the last 50 years. Instead, calibrate it for one specific period of time, one decade, and then test it against the other decades. Because you might find, wow, it's perfect for the 80s, and then you test against the 70s and it's complete garbage. It's of no value at all. And you think, okay, maybe I can't trust this model. So how do you mitigate it? You test, especially, and this is always my thing, test it at the extremes. I had one model, boy, this guy, he was a Russian mathematician. He sounded really smart. He had that Russian, he sounded like Henry Kissinger, a mathematician. I mean, this guy's brilliant. So I took his model, we were buying his model, and I looked at the extremes. And I go, your kind of worst case scenario in 10,000 is for the S&P 500 to fall 30%. I don't consider that a 1 in 10,000 year event. I think it's going to fall a lot more than that. You gotta put up the amp on this thing. We need more risk than that. Our interest rates only move that much. I did what's called a spaghetti graph. I just graphed every single scenario and I just looked at the range. I want to make sure the range was wide enough to make sense for what I would think risk would be. So model errors become much more obvious in the extreme. So test your model, put some extremes in there. Double check, triple check your models over and over again. Have someone else run it. Logical design, this is something you really want to be careful of as you do more modeling. Spend an extra hour, 2 hours up front, documenting, making it clear as much as you can do that up front. Don't have formulas go on 200 characters. Break it up so you can see the individual pieces. And then when you make a mistake, admit you're wrong. I made a huge mistake once. We had a model. I was responsible for building mortgage-backed securities, which are really, really tough to build. And the actuaries built the liability side. And I took the results in to the CEO, and he goes, "Yeah, I don't think that's right. There's no way that can rhyme." I'm like, "No, we double checked it. I'm sure it's right." While I'm saying that, I'm thinking, he's got a really good point. But I'm like, no, we got it. So I'll go back to Mary. She's the actuary. I go, Mary, can we look at cell whatever? And she looks at it and she says the worst 2 words you can say, which is what? Well, before that, I discovered this is also the Spanish. It's the same word in Spanish. It's uh-oh. I remember I threw a frisbee to a kid in Costa Rica and I heard him say uh-oh down the mountain. So yeah, uh-oh, you don't want, and that's what she said. Uh-oh. I just told the CEO we were absolutely sure. So you're better off saying, you know what, that's a good question. Let me go back and double check the model. Just don't set it up that you're perfect. Set it up that, yeah, we have errors in our models. Let me go double check that. That's a good question. Let's make sure and confirm that. That's what I should have said in a meeting. That would have made a lot better sense. This book I do recommend by Nate Silver. There's actually another book I highly recommend. Yeah, here it is. I highly recommend this book. And it's $0. Well, that's for me. I don't use all my Audible credits. Excellent book. What they're doing in this book is they're saying, okay, because there's these websites out there to do predictions, and now they have data on the predictors. And what they're asking in this book is what's the difference between the good forecasters and the bad forecasters? And what are you going to be doing the rest of your life? You're going to be forecasting. Do you want to be a super forecaster or a horrible forecaster? Well, you want to be super. Now, can you become a super forecaster? Or is this something that's innate? These people are born with it. And that you read a book, you can discover there's some certain things they're doing that you could do. You could emulate them. So it's a really good book, inexpensive book, $17, a lot cheaper than your textbooks, but a really good book. I need to read it again. Tetlock is really famous in this area of forecasting and predictability and those kind of things. He's someone you want to read. We'll see his name come up a couple more times in the class, but really good book. So those are some books on forecasting, which you as a finance major or an actuary, you want to understand that. What Silver is saying is, how do you know you're forecasting based on, good data, or you're just taking noise and forecasting noise? How do you distinguish between actual good statistical data and just noise? We do tend to, in finance, to be so desperate for data, we'll take completely random noise and go with it and build a model off of that. And we're like, oh my word, how did I use that? But it's a good book as well. You probably have heard Nate Silver. He's kind of famous in the election predictions. Here's some good quotes. All models are wrong. Some models are useful. I like that. It's a great quote. And then I can't remember who said this. Oh my word. Great quote though. Models are not evidence. And say, oh, I can prove it. Look, it's in my model. So yeah, all you proved is that your model has that result. It doesn't prove that it's a good data at all. Take this really seriously. There's not much you can do other than just being careful and testing the extremes, but be really careful. A lot of decisions are made off of finance models. I remember when I told USA go to 0% mortgage backs. I can't remember if I told y'all this, but I went to the CFO and I said, hey, Joe, we're about to sell $20 billion based off of an Excel model I built, and no one else in this company has looked at it. Just letting you know. He's like, oh, okay, maybe we should go double check Ron's model. It's like, no, yeah, I just letting you know. Y'all never asked, no one ever questioned. We're about to do it, but yeah, let's go for it. Here's a quote from someone a little bit further back in time, Aristotle. It's the mark of an educated person to look for precision only as far as the nature of the subject allows. Don't go out 17 decimal places if it's that kind of thing. We do that a lot in finance. Why? Because I love it, especially cost of capital. Boy, you can go out 5 decimal places on the cost of debt, and then cost of equity is like this. Cost of equity is 80% of your WACC, but hey, I can go out 8 decimals on cost of debt, so let's go out. Why do it? Just round it because it's not that critical. One problem with going out at 8 decimal places when you don't have that kind of precision is it kind of imply you have implicit precision. And so I say, if you don't have the precision, don't, just round it. You're going to see that with project 2. You're going to get this precise asset allocation. You can say, wow, that's the perfect allocation. It's going to take my portfolio's expected return from 6.8% to 6.84%. Do you think we're really that good? It's like, oh yeah, it's 4 basis points better. That's getting lost in the rounding, right? So, and then obviously Doug Hubbard, he's a little bit windier, but it says some really great things. Ineffective methods are used with great confidence, even though they add error to the evaluation. Perhaps much effort is spent on seemingly sophisticated methods. What is he talking about here? He hates heat maps. I hate heat maps. I know some of your firms use them. I don't know if, Reginald, you've had a firm use heat maps, and any of y'all use heat maps? Yeah, they like them.
Just for correlation purposes to
Yeah.
see where everything's concentrated.
Doug Hubbard says they're useless. I think they're less than, well, he thinks they're less than useless. I don't like them, but there may be some areas they are valuable. I've had some engineers saying in our field they actually work, but at USA, I found them to be completely useless. But that's what he's saying. It seems sophisticated, but there is still no objective measurable evidence. So that's part of what he's saying. They're using heat maps. So you ask them, well, are heat maps making your firm better or making it worse? We don't know. We have no evidence that actually using them is making us less risky. But we're using them. Say, okay, well, without the evidence, why are you spending millions of dollars putting these things together? That's part of his argument. These sophisticated methods are far worse than doing nothing. That's a pretty big comment from his standpoint. Are simply wasting money on ineffectual methods. They cause erroneous decisions to be taken. That's why he says they're worse than nothing, because it gives you confidence to do something you really don't have the data to do yet. That otherwise wouldn't have been made. Note that in this spectrum, doing nothing about risk management is not actually the worst case. It's in the middle. Those firms invoking the famous, at least I'm doing something defense, are likely to fare worse. Doing nothing is not as bad as things can get in risk management. The worst thing to do is adopt soft scoring method or unproven but seemingly sophisticated method, crackpot rigor is what he calls it, and act on it with high confidence. That comes another book I highly recommend, highly recommend, The Failure of Risk Management. It's a really, really good book. Um, he's a good writer, good speaker. He has 2 books out there that I highly recommend, this one and How to Measure Anything. You're going to listen to his video next Thursday night, so you'll see that one. What he has to say there, really good presentation. So he's longer winded mainly because he's taking on some things that have been sacrosanct in finance, and he's questioning them. And he has the data to show it. He actually shows firms that do these kind of things and firms that do his methods, and he shows you're better off with my methods than you are with these methods. But be careful. You're gonna be building models. Are you adding value or are you destroying value and feeling good about yourself in the process? The next one is legal risk, one of my least favorite ones. You have a contract that's misinterpreted or reinterpreted in a way you didn't expect. What is the purpose of a contract? You realize one of the most important purposes of a contract is risk management. It's deciding who bears the loss when something bad happens. That's what a contract is for. That's why on those swap contracts, I was like, all right, what does this contract says happens if this happens? Do I have that power? I want to understand this very, very clearly. I am shocked you guys don't take business law. We had to take 6 hours of business law, and I can't believe y'all don't take business law is so crucial. You can do it yourself. There's some really good business law courses out there that you can take. You need to know the UCC code. You need to understand all the regulations related to investments and other things. What I found at USA, I was asking to do things like swaps and other things. Our lawyers didn't know any of that stuff, and they weren't going to learn it. They didn't have time. We're talking really specialized. So they told me to write the contracts. It's like, I can't write a contract, I'm not a lawyer. And they're saying, no, you just write what you want. It's like, that's crazy. But you better have some contract background because you're either going to have to be writing the contracts or you're going to be interpreting them, and it can get pretty complex. So our lawyers just said, hey, we'll give you the boilerplate language that USA uses. You tell me what you want everywhere else. We did a contract for an option trader. And me looking at that, and what am I thinking? I'm thinking risk. What could go wrong? So that I can make sure I can get some kind of recourse if something goes wrong. So you think of it, I've only sued one time in my life, and it was a contract suit. My apartment complex refused to give me my deposit back. And so I told the lady, well, I'll sue you. And said, well, sue us then. And she's laughing at me. So I sued them and I won. I was really happy about that. But what I didn't like about that, other than they didn't get my deposit back, was their contract shifted risk to me for stuff I had nothing to do with. If my neighbor burns my apartment down, they want me to rebuild it and pay for it. If my neighbor breaks the window in my house, they want me. It's like, no, you can sue my neighbor. I'm not paying for that. If I'm responsible, yeah, I'll reimburse you. But if my neighbor messes up, I'm not taking on all the liability of all my neighbors in this. Have y'all read your apartment lease? Read it again, thinking in terms of risk sharing, risk mitigation, risk shifting, and you might open your eyes that like, why in the world am I agreeing to that? But anyway, this contract I had, it said on the deposit, we have the right to keep your deposit if, and then they left that blank. So there was nothing there. I won the lawsuit only because they didn't show up to court, so they kind of helped me out. But still, I was kind of happy to do it. I was really happy. She was lividly mad, but then the person who actually paid me was real friendly. Oh yeah, I'll send you a check. So contracts are important. They are extremely important from a risk standpoint. Read your contracts, interpret your contracts again at the extremes. What if this happens? What if this happens? Think of it in those terms and then ask questions. So if this happens, you're going to do what? You're going to send me money, or I'm going to have to send you money. How do you measure it? It's how big is the contract? I showed you that swap contract. That's a bear to get through. Complicated language, not well written. Yeah, it's frustrating. And your legal team at your firm, if you're doing something the firm's never done before, they're not going to help you out. I was really, really nice to our lawyers and our accountants and our tax accountants because I was always showing up with stuff they didn't want to have to mess with. They were busy. I had to acknowledge that they were busy. You don't go to a lawyer and ask, can we do this? You go to a lawyer and say, help me understand how we can get this done. If you have to ask a lawyer, can we do this? They'll just say no because it reduces their workload. I don't know how busy they are because they intentionally put stuff in their inbox so it looks busy, but I think they're probably pretty decently busy people, and this is complex stuff, and they don't have the background because they're insurance lawyers. They're focused on insurance contracts, not investment contracts. So it's tough. How do you do this? Be careful in the language. Um, what do you want the contract to do? Ask many questions, and again, go to the extreme scenario. Don't trust lawyers. I should say, don't trust salespeople. I found that out with Northern Trust. I had a contract with them, but before the contract was written, I was asking the Salesforce, now if this happens, oh yeah, 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 don't worry, no problem. And then I get the contract. It's like, wait a minute. Well, it went from the sales floor to the trade desk. The trade desk, yeah, we don't do that. Okay, I shouldn't listen to. A salesperson has an incentive to do one thing, is let's get new business. But I'm not going to sign a contract just because the salesperson says, "Oh, don't worry, it's in there." Um, Lawyers are trained to pretend like they know what they're talking about. Many of them have very weak backgrounds. I've talked to a few students who've gone to law school. We desperately need a finance major to go to law school and come back and specialize in this area because there's a lot of complicated contracts. It could be on the private equity side. They do a lot of contracts there. You saw the swap contract. Hedge funds have some pretty complex contracts with their customers. You're going to start your own firm. You're going to have to figure these things out that are pretty complex. Um, I had a great relationship with our lawyers, talked to them, made sure when I showed up that I recognized this was time consuming, it's gonna be tough, but this is really critical for USA. We gotta get this done. And then thank them afterwards. One of the nicest people I've ever met in my life was a lawyer at USA, really, really nice guy. Really, really helpful. They're nice people, but they're busy people. All right, the next one, we talked about the lawyers. What about the accountants? So then you bring up the risk of disclosure risk. And I think we talked about this. There are some accounting pronouncements you need to know. So we talked about 157. Anybody remember 157? Takers on that one? Have y'all studied 157? Fair value measurement. You're going to work for a bank, an insurance company, a mutual fund, a hedge fund. This is a FASB you better know really, really well. How many levels are there? Anybody remember that? No takers on that. Did we talk about this? Did we mention it? No. So essentially what FASB, the Financial Accounting Standards Board, is saying is you've got some assets on your balance sheet. We got to put a value on them. And how are we going to do that? And they said, well, there's 3 levels. I would know that. I wouldn't go to an interview with a bank, insurance company, hedge fund, mutual fund, and not know that FAS 157 has 3 levels. You can kind of guess the 3 levels. Let's see if it's in here. Level 1, it's something that has a quoted price. It's publicly traded like stocks. How confident are you in valuing stocks every day? Pretty confident, right? That's a market value you can trust. Not too difficult. Level 3 is the worst case. Level 2 is that in between where you can build a model to come up with a valuation based on other assets. That's where corporate bonds come in. Corporate bonds on that level 2. They don't trade every single day. You don't have a good, reliable price, but you can put a corporate bond into a model, look at what similar bonds are trading for, and come up with a valuation that you can be pretty confident about. But then in a year like 2008, level 2 assets can really surprise you. Something we call price discovery, where you thought it was worth 80 cents on the dollar, but then someone sold the bond and now you have price discovery and now you discover, wow, it's really only worth 70 cents. That's level 2. Level 3 are those really, really hard to value assets like real estate, things that just don't have publicly traded normal data. So I would nose 153, 157. That's a disclosure risk. If you don't understand that, you're going to be surprised. You don't want something to happen on accounting that you didn't tell management about. And they're like, wait, I mean, we just have to write off 20 million bucks. Oh yeah, I forgot about that level 2 thing. What about, I forget which FASB this is. Let's see if it comes up. FASB. Does this tell us which FASB it is? If anyone sees it, let me know. 115, is that it? I don't remember my numbers. Yes. Have y'all heard of this one? Available for sale and trading assets. Does that sound familiar? You've probably seen that somewhere. This is a huge one. This was a huge issue at USAA. So you have held to maturity and trading assets, and then the in between. I forget what the in between is. Held to maturity, available for sale. So held maturity, available for sale, and trading securities. Those have very different valuations. And the problem is, if you do held to maturity, it's nice and stable. You don't have to write them off. You have to have them go up and down in value. But what we discovered at USAA, if you have a held to maturity portfolio that's like 10 billion bucks, say these are held to maturity, we don't need to mark them to market every day. So they're nice and stable. If you sell one bond in that portfolio, you taint the entire portfolio. You sell one bond, you said you can hold at maturity, and instead you sold it early. Now every security in that portfolio has to be marked to market. So especially life insurance companies, they love held to maturity. But then, well, what if it gets downgraded? We don't like the credit, and it doesn't matter. If you sell that bond before maturity, you taint the entire portfolio. Can you imagine discussions we had? Is it held to maturity, or is it available for sale, or is it a trading? The trading securities you just mark to market. So that, but I don't see y'all see the accounting 115. There you go. So 157, 115, you should know those if you're going to interviews with insurance companies and banks. Any entity that owns a lot of bonds, this is a big, big, big deal. And then you have FASB 133. Anybody know that one? So that's the accounting evaluation of derivatives, like swaps and futures and options. That's a pretty important one. When I did swaps and options at USA, my boss came by with 2 books that thick on FAS 133 and said, here, read this. Fortunately, I didn't have to read it. Fortunately, in 133, which is, I didn't want to read, I have a CPA, but I don't consider myself an accountant anymore. I didn't want to read this stuff. But USA had just hired a new accountant, and this was his specialty. You think I was glad he showed up? So I go to his office. It's like, hey, Ron, here's the bottom line. Blah, 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 blah. Can you live with that? Yeah, I can live with that. Made it so much easier to me have to go through all of those pages. So 133 is pretty important. So what are the 3 you should know? 115, what does that do? Held maturity. All right, 115. 157, how many levels? 3 levels, and then the 130. 133 is the derivatives. Going into interview, I would know those. You might think that's accounting. I can tell you all the finance people, I can never remember 115's number, and I forget 157 sometimes, but I know the pronouncement. I know the available sale and trading. And I'm retired 16 years ago, but these things were so huge. So there are certain things in accounting. How many of those do y'all see in your accounting class? Because my graduate didn't cover any of those. They may not have existed when I was undergraduate. Do y'all see any of those? Some of them? Did they tell you how important they were when you studied them? It's like, make sure you remember this one, or they just say remember everything, right? You kind of don't know. But that's the disclosure risk. And that means you got a risk that you can't do something because the accounting is so complex. You just can't handle it. And there are some things that are really, really complex. It can be complex because of the legal side, regulatory side, but here really the accounting side, any of those. So how many pages is the regulation, or how complex is the accounting rules? Anything that you've got to disclose to the regulators, or anything you got to disclose, how complex is it? You don't want to do something in finance that now you got to hire 10 people just to monitor it and report on it. So make sure you know those rules. Very important on the tax side and on the disclosure side, that if you're getting something approved, that you've gone in detail on those issues. You don't want to go before the CEO and propose something, and the CEO turns to the CFO and says, has he talked to you about this? No, I haven't seen this. First time I'm hearing this. That's not what you want to do. You want the CFO to say, yeah, we talked to my department, researched it, and yeah, we're comfortable with it. We can handle it. So start with those departments, let them know what you're doing. They used to be like, when I showed up, it was like, oh no, Ron's showing up. But I would give them plenty of time in advance so they're working on it. So that's my mitigation. Get to legal, get to accounting as early as possible in the process. Let them do their work. We'll talk about the same thing on the tax side. Let them do their work. You're going to spend a lot of time reading and thinking about different scenarios. What does this mean? What does this mean? How does this accounted for? How does regulation work on this? And sometimes you hire lobbyists and try to get the rules changed. So the key here is get ahead of the curve and address these issues before you approve. You're going to have some of your best ideas will be completely shut down because you just can't do the reporting. It's just too much for you. Kind of frustrating. So Dodd-Frank was passed after the 2008 crisis. Just look at some of the numbers here. There is an ever more apparent risk that the harm done by massive cost and complexity of the regulation and its effects of its internal inconsistency will outweigh what good it will do. The law that set up our banking system, it was 29 pages. The Federal Reserve Act set up the Federal Reserve was 32 pages. The Banking Act, Glass-Steagall, was 37 pages. Dodd-Frank is 848 pages long. Now think about our government. We have Congress. How many of our congressmen and women are expert on those 848 pages? It's a pretty complicated bill, isn't it? Pretty advanced mathematics, pretty advanced banking. You think our congressmen and women, who actually writes our laws? Have you ever thought about that? Do you think Congress writes laws? When's the last time Congress wrote a law? Who writes our laws? Consultants, right? They farm it out. The Affordable Care Act, I can promise you Congress did not write the Affordable Care Act. It was written by a bunch of consultants, 848 pages, and then what are they given? 2 days to review it and vote on it. So these are complicated things. Dodd-Frank, you think 848 pages, forget about that, because there are questionnaires that go with it that you have to fill out. 383 explicit questions. If read closely, break down to 1,420. So banks have to answer all these questions. They send it back to the regulators. What do regulators do? How good do you think regulators are in addressing these 1,420 questions? Think they're doing it well? Is it coming to them on paper? Is it coming to them electronically? Do you think the people who wrote the law realize the regulators now have this massive paperwork they've got to deal with? Is this a good way to manage the risk of banks? So this guy up here said, laws classically provide people with rules. Dodd-Frank is not directed at people. It's an outline directed at bureaucrats, and it instructs them to still make more regulations to create more bureaucracies. Essentially what they did is just made the world very uncertain for banks. At USAA, there's a lady I worked with at USAA, really, really sharp at what she was doing. One of their most impressive employees. I thought she could become the CFO of the bank. They put her full time on Dodd-Frank. I thought, oh, what a waste of talent. You want her doing a lot of other things, but they had her working on Dodd-Frank. Do you think that's the best solution for our economy to have someone of that caliber doing nothing more than trying to figure out a law that's so complex? Along with all those questions, they also mandate 87 studies. And the problem is no one's scrutinizing all this. Congress passes it, and then it's like, I hope it all works out. And then it's just this incredible mess. But the really big issue with Dodd-Frank is how they operate, how much they cost, how they fund it. It is the risk that they and other parts of the apparatus will smother financial institutions so much that innovation is killed. It just destroys the economy. So yeah, the bill has a cost, it's complex and all that, but it also may just destroy us competitively. Officers are being given the power to regulate more intrusively and make arbitrary and capricious rulings. And plus, you switch between presidents. and everything changes because they bring new people in. You know, it's like this moving target. And then you encourage the biggest and most sophisticated banks to play the system. Have y'all heard of regulatory capture? What does a regulator want to do? They want to see their salary doubled when Goldman Sachs hires them. If you're a regulator, you want Goldman to hire you, you're going to be a really strict regulator. Or are you going to be a little bit, oh yeah, I think I'll let you get away with that. So it's incredible bill. I gave you all that book, how regulating Wall Street, and they assessed Dodd-Frank, and they don't think it would have prevented the 2008 crisis. They don't think it would have done much. It's really complicated, really expensive, and probably was not effective. What did Dodd-Frank actually do? Made banks hold more capital, put limits on debt, put requirements on liquidity. They had to have a resolution plan. You know, what if this goes wrong? What if this goes, that's essentially stress testing kind of thing, concentration limits, like we talked about. What happens if you don't have enough capital? Where are you going to get it from? Are you going to issue stock? You're going to do other things, more disclosures, some other overall requirements, but probably did nothing for the too big to fail, probably didn't change that dynamic at all. We as taxpayers are really on the hook for these big banks. So would Dodd-Frank have prevented? So I do recommend that book, Regulating Wall Street. I think it's an excellent book. It sounds so boring, but it really does a great job. You know, as I said, it's shorter. It's a book written about Dodd-Frank that's much shorter than the Dodd-Frank bill itself. You know, you can love finance, but you won't love everything about finance. There is the downside. You've got to deal with some of these kind of boring, tedious things, but you got to get good at it. And you got to make good friends that are good at this as well. So don't step on toes, don't burn any bridges. You need people to help. We should be respecting each other anyway, right? But you're going to need these people to help you out. So don't be bad-mouthing lawyers in the hallway when you're going to need them 2 weeks later to do this for you. Treat them well. They are smart people, but they don't have expertise in some of these areas. And then tax risk, kind of related. Tax risk is huge. And what tax risk means, there's 3 ways taxes can throw you off. But what tax risk is saying is you have this great idea that worked great before taxes and completely falls apart after tax in 3 ways. One is timing. The second is character. And the last one is sourcing. Timing is, and I'll talk about timing with the options we use at USAA, but timing is you're hedging something, and what you're hedging has a loss, and the thing you're hedging it with has a gain. Say, wow, perfect. But the loss is not tax deductible, but the gain is taxable. Like, oh man, that didn't work out well. That would be the timing. That is the case with options. If you're going to do options, stick them in your Roth IRA. All right, the tax rules on options are horrendously bad. The IRS loves the tax option gains immediately, and they love the deferred option losses forever. So be careful of that. Character is, you think it's going to be taxed as a capital gain, but it gets taxed as ordinary income. So it's taxed at 30% instead of 15%. That's pretty huge. And then sourcing, you think it's going to be taxed in the US, and it ends up getting taxed in Europe or somewhere else. And yep, you're using the wrong tax rate. So timing, character, sourcing are all important. How do you measure this? You just look at every possible scenario. So when I did options, now fortunately when I did the swap at USAA, we did that in the pension plan. Pension plans are tax-free. So that was really good. I could do whatever I wanted in that pension plan. I didn't have to worry about it. No tax implications, anything. When I did the options on our stock portfolio, that was in a taxable entity. So I had to look at those scenarios. So we had to do the scenario, what if the stock market's down and our options are up? What if the stock market's up and our options are down? I had to go through those scenarios. I did it at the extreme. Fortunately for me, I have a good friend who was head of the tax department at the time. She's retired since then. She's an avid bicyclist. She's actually ridden across the entire United States twice, not in the same week, but over different summers. So good friends, and her department was exceptional. I was so impressed. So she gave me this one guy, I can't remember his name. I should go back and see if I can find him, just to tell him I'm talking about him in my class. But I came to him and said, I want to do options that hedge our stock portfolio. I need to understand the tax implications. And he wrote me a 16-page paper. He covered all the issues. And essentially told me, yeah, it's pretty hopeless. So what I had to ask him is, okay, let's say the stock market's down, so our portfolio is down 30%. So let's say we lost 500 million bucks. All right, but we have options and they're up 500 million bucks. That's great. Fortunately, my $500 million loss on the stock portfolio, I haven't sold it, so I have no tax losses. That's just an unrealized gain. But the options I've sold. So I say, I know what I can do. I'll just sell the portfolio and rebuy it. Can you do that? What does the IRS say on that? It's a wash sell. How long do I have to be out? Like 90 days? So
30 before 30 out.
yeah, I can't remember the rules. I knew them back when I did this. So I have to be out. Am I going to get out of stocks just so I can get the tax loss? Does that make sense? That doesn't make sense. Um, so then I tell them, oh, you know what I'll do? I'll sell the portfolio and I'll buy it back in two pieces and weight it more toward growth stocks than value stocks. And my argument would be, I didn't want the S&P 500. I wanted to have more growthy. So yeah, that's not going to work. And his argument was, yeah, when the IRS calls and you say that's the reason, they're going to put you under oath and you're going to be in court. And you know good and well the only reason you did that was to get the tax loss. So yeah, that's not going to work. So he's not very encouraging, is he? We could not think of a scenario where we could get this to work out. Our final solution was, let's talk in November. So in 2008, we had these large losses on the stock portfolio. We had these massive gains on the options. And it worked out perfectly. Why? Because 2008 was so horrible. We had plenty of losses everywhere else. And he was actually happy we had the option gains because now he had some gains to offset those losses. So I actually did him a favor. So it actually kind of worked out. But, you know, that's luck. There was no solution here. We were just lucky in 2008 that we had all these massive losses everywhere else. Taxes can be tough, and there's just not a solution as the IRS. And the problem with the IRS is people have so played games with this, take advantage of tax law, that the IRS changed the rules so they harm everybody, the good people and the bad people, because they want to, you know, harm the bad people, and it's tough. You can go to the IRS and get a ruling. They don't necessarily have to stick with it, but they may give you a ruling on that. But it's, you know, even then they can change their mind. Get to the tax department early. And again, go through all the scenarios you can think through. I was really fortunate they had a great tax department. I think he actually enjoyed the project and he did such a great job on it and really fast. And we sat, I mean, that's what you want to do, right? You want to do this right. We sat there and go through scenarios. And he didn't say, yeah, I'll figure out some way to figure it out. We essentially said, yeah, there probably isn't a solution here. We got to be careful. I got to make sure to tell management, you might have the gain and the losses may be off by our tax rate. Just be aware of that, and that can be an issue. But we were lucky. I was lucky on that one. This is true for your personal portfolio as well. So that Roth IRA is really great. It's tax-free for the rest of your life. The most complicated stuff, you need to put in that Roth IRA, especially options. If you're going to do options, do it in a Roth IRA because, boy, it's just really, really protects you. I have other deferred accounts like my pension plan. When I liquidated that, that's sitting in a tax-free account. I can do all kinds of stuff in there. But in my taxable accounts, options are just, be really, really careful. You don't want to be surprised on those. Questions on taxes? Hopefully you have a tax department can help you with that. All right, the next one's massive, but we're not going to go through every conceivable scenario. Operational risk is kind of a catchphrase for everything else. It's all those other things the firms do that can cause major losses. It's procedures or policies or operations. So here's where the internal controls come in. So your internal audit especially is going to get into that. Your hiring process is really important. At USAA, I interviewed a lot of students. Actually, they asked me to do college recruiting, and at that time, they refused to interview at UTSA. And I said, I'll interview if you add UTSA to your list. And they said, okay. And then they fought over the UTSA students. They wanted them more than the A&M and UT Austin students. And I said, see, I told you, it's a good school. And what they really love about UTSA students is if they offered UT Austin students a job, what did they do? They held it in case they found a better one and took the better one. They offered a UTSA student a job, they took it. And USA finally figured out UTSA students are as good as UT Austin, if not better, and they'll actually take the job and not have it as their second choice. So, but that's the hiring process. And the hiring process, I like to ask really wild questions, like what is beta? That's a question that finance students will go for hours talking about. I've asked students from my class questions we talked about in class, and I almost felt like kicking them under the table because they had no clue. I was like, yeah, we spent like 3 classes on that. How could you not know that? I remember asking a graduate student from Yale about the beta question. He had no clue what it was. Pretty fresh. But USA started telling me, no, you can't do that. You have to ask every recruit the exact same questions. Because if you don't, one of them is going to say, hey, I got that question, you didn't, that's bias, you can't do that. So I either have to think of every possible question I could ever ask, or I got to stick with the script. And so I just stopped interviewing because it's like, that's not fun. I want them to hear them talk. I want to throw a question up that a finance major should know. There's certain things finance majors should know. It's amazing how little finance majors that I interviewed back then actually knew just about the basic stuff that I know they saw in 4 or 5 classes. But for some reason, they can't do it conversationally. They could only do it multiple choice. If I gave them multiple choice, I probably would have done okay. But in the conversation, it was like, yeah, I don't know what beta is. It's like, yeah, boy. So that's the hiring process, reputational risk, negative headlines, those type of things come up. They're pretty major. I remember at USAA, one of the things I think is really critical to risk is a new CEO, new management is really major at USAA. Each CEO had a huge impact on the firm. And I still remember there was this one general that was in line to replace McDermott. Pretty important. Y'all don't know who McDermott was, but McDermott, I was in meetings with him just twice, kind of a scary guy. But his replacement was picked. And this guy was so weird, my word. So he would randomly call people to come have lunch with him. And it'd be 5 of us, and we go have lunch with him. He would lecture us for an hour, and then we had to ask him a question. And you're like, I don't want to go to this lunch, first of all. And you have to ask the question, and you have to have 3 questions because if the person next to you asks the question you're asking, you got to come up with another one. So you go in there with 4 questions. You don't care what he says. You just want to ask your question and get out of there. He was just horrible, man. Fortunately, I mean, if he had become CEO of USAA, and she's not related to him, she told me she didn't leave early, so she's not like offended. But the USAA, if they'd hired this guy, I think it would have been a disaster, absolute disaster. Instead, they hired Bob Harris, really great guy, really smart guy. I love working with that guy. I mean, it would have been night and day. And then a few years after that, I love telling these stories. Y'all love these insights. A few years after I went on a bike trip, and one of the people on the bike trips was this woman from Goldman Sachs who had been bidding the process for USAA debt. And say, wow, that's interesting. You worked for Goldman Sachs when USA was issuing debt. She said, yeah. And she brought this guy up, and I go, oh, you had interaction with him? She said, yeah, this was a young woman. And this guy was a much, much older man. So guess what he did on this trip? Anyone want to know? So late at night, he got her hotel room, went up to her hotel room and invited her out for cocktails. Does that seem appropriate? If you're a young analyst at Goldman Sachs and the soon-to-be CEO of a company you're bidding for business asks you for cocktails, does that seem like something you would want to have happen in your life? She was very confident, and she said no thinking and closed the door. And then she said something to kind of make my skin crawl. It says, yeah, I'm kind of wondering how you got my room number. But yeah, it's kind of interesting. A married 60-year-old man asking a young woman out for cocktails when they're bidding for business that aren't, do you see why I did not want him as CEO of USAA? That's a horrible person, but that's pretty important. That's kind of reputational risk when you hire a CEO. You saw that right with Uber and their problem with their CEO, and you have other companies. So when your firm hires a new CEO, is this person a person of integrity? Is it a person that's going to drive this company into the ground? So those type of huge reputational risk are important. Lawsuits that you have, operational risk and disasters are really important. Adequately insured. How do you measure it? It's really, really tough. Businesses are big, they're complex. How do you measure it? One thing I do all the time in my life is assess close calls. So I'm a bike rider. Anytime I have a close call on the bike, I think about it. What went wrong? And one thing I frequently do is change my route. So I ride my bike 4 hours every morning from here. And I go over to Helotes. I keep changing my route. There's one place where it's just a blind place I have to cross, and it's like I've almost gotten hit a few times. Okay, I'm going to go this way instead. So there's places where I slip and fall and think, okay, what happened there? And I assess it and I take another route. Close calls are really, really good to do because why was it a close call? And next time it may not be such a close call. So airlines are really good at this. They don't just assess plane crashes, they assess close calls where planes almost crashed, almost hit, and they go into detail. In fact, they go as much detail on close calls, even though nothing got hurt, no one got hurt, nothing got damaged. They go as much detail on calls as they do as on major accidents. Aren't you glad they do that? That sounds like good risk management, right? So that's one way you can do it. Always redesign your policies and procedures. Process is really, really important. You can't just look at past performance. You want to look at the process and think about the process because there's things that happen once in 1,000 times. The fact that it hasn't happened in the last 100 times doesn't mean anything because you have something that can bring down the entire company. And then one thing, I talk about this later. This is something, I'll end with this because you're going to think I'm crazy, so I'll leave you thinking I'm crazy. One thing I did at USAA was I sat down and figured out how could I destroy this company. And should one person be able to destroy USAA, do you think? Probably not. So I would figure out, so when they let me do option trading, here's how they did it. Yeah, that's fine. Does that make sense? I could destroy this entire company with a really bad option trade. And they're like, yeah, that's fine. We trust Ron. It's like, how do you know I didn't just have a really bad breakup or whatever? I'm just going to bring everybody down with me. They're like, no, it's Ron. We trust him. So I set up my own compliance. I went to the measuring guys and said, hey, every single time I do a trade, you need to get the email from the broker. You need to make sure it's within policy, that it makes sense. And you need to send out an email that everything's fine. And after I set up my policy, I then went to the CEO and said, y'all realize what y'all just did? Y'all gave me all this power with no compliance, but don't worry, I got the compliance in place. But that's a really good trick, is just figure out how could you destroy this company. And if you could do it, figure out how you can control that and make it not happen. So, all right, we'll finish up operational risks here.